Welcome back to The Explainer. Today, we're diving straight into the absolute seismic shifts we've seen in the AI landscape during the first half of 2026. This isn't just about small, iterative updates, We're tracking tectonic movements in how capital is flowing, how the bedrock infrastructure is being locked in, and how all of this is already resulting in massive, real-world shifts in the enterprise workforce. All right, let's kick things off with a number that literally shatters every record in the book. In just the first quarter of 2026, total AI venture funding hit $255.5 billion. To put that into perspective, that is roughly the entire GDP of New Zealand, deployed in just 90 days. Why does this matter? Well, because that single quarter of funding actually surpasses the entire global AI capital deployment for all of 2025 combined. We're looking at the highest single quarter capital deployment on record, and it signals a massive acceleration in market conviction. To make sense of this unprecedented influx of money, here is our agenda for today's explainer. 1. Following the venture capital. 2. Solidifying the AI infrastructure. 3. The efficiency and cost race. 4. Workforce and enterprise impact. And 5. What you should track moving forward. Let's jump right into Section 1, following the venture capital. Because $250 billion doesn't just spread out evenly. Look at the sheer concentration of wealth. The vast majority of that $255 billion went into just 3 massive bets on what we call horizontal platforms. OpenAI took a staggering $122 billion alone. That's followed by Anthropic at $30 billion and xAI at $20 billion. For developers and business leaders, this capital story matters deeply because it signals exactly where tooling, APIs, and long-term platform support will be maintained. Investors are clearly treating the infrastructure layer as durable, and they're backing it with historic sums. And this creates a really fascinating divergence in the market. While those horizontal platforms saw record funding, the story for vertical applications, the highly specialized tools, was totally different. Vertical deal counts actually dropped 51%, hitting their lowest point since 2018. But wait, look at the other side of that equation. Their average deal size more than doubled to $24 million. So investors are basically consolidating their bets. They aren't funding the entire field anymore. They're playing kingmaker and picking the likely moat holders in each specific vertical. Moving right along to Section 2, solidifying the AI infrastructure. So what is all that horizontal platform money actually building? Well, it's building foundational infrastructure, heavily evidenced by this milestone right here. By March of 2026, Anthropic's Model Context Protocol crossed an unbelievable 97 million installs. It has officially crossed the threshold from an experimental specification into a mandatory production standard. If you're wondering what that means for you, MCP is essentially the new plumbing of the AI world. It's the default open standard mechanism for AI agents to connect to external tools and data sources. Every major AI provider is shipping MCP-compatible tooling right now. And what really cemented this was the Linux Foundation announcing it would take MCP under open governance. For regulated industries, that move completely dissolves the enterprise vendor lock-in concerns that previously slowed down adoption. Seriously, if you're building agentic workflows today and you haven't standardized on MCP, you are quite literally swimming against the current. Let's move to Section 3, the efficiency and cost race. As that infrastructure gets locked in, the competition shifts dramatically toward making these behemoth models cheaper and less memory-intensive. We're seeing this play out in the research labs first. At ICLR 2026, Google unveiled TurboQuant. Now, this is a breakthrough algorithm that tackles the KV cache memory problem. Think of the KV cache as the short-term working memory of the AI. It grows the longer your conversation gets, and honestly, it's the primary bottleneck for how many concurrent long context sessions a GPU budget can actually handle. TurboQuant significantly reduces that memory overhead. For teams running inference at scale, this is huge news. It translates directly to either lower hardware costs or way higher throughput. But let's move directly from the research lab to production reality. On March 4th, Google dropped Gemini 3.1 Flashlight. And the math here changes the whole game. It's priced at just 25 cents per million input tokens, delivering 2.5 times faster response times and 45% faster output generation compared to earlier versions. This is a massive deal. It makes high-volume workloads, things like classification, routing, and extraction, incredibly cost-viable without needing entirely separate fine-tuned models. The true cost efficiency tier has officially landed. Which brings us to Section 4, Workforce and Enterprise Impact. Now, let's bring it all home and look at how this cheaper, faster infrastructure is hitting the human level. We need to talk about the real-world impact, and we have to anchor on this incredibly sobering figure, 34,000. That is how many jobs were cut across Oracle and Block in a single month, March 2026. And what makes this so critical to understand is what they said on the record. These weren't your standard corporate restructurings disguised as strategic pivots. No, both companies explicitly cited AI automation as the driver for these redundancies. This absolutely proves that this technology is no longer just some abstract future threat to knowledge work. It is a present workhorse reality. AI-driven automation has moved from the pilot phase to operational scale at a pace where massive enterprise headcount decisions are actively being executed. At the exact same time, we're seeing operational deployments moving at breakneck speed. AWS expanded Amazon Connect into purpose-built agentic AI for supply chain, hiring, and health. And get this, enterprise customers like United Airlines took these from a concept to live production in under 3 months. Meanwhile, on April 23rd, OpenAI rolled out ChatGPT for clinicians alongside HealthBench Professional. That's a standardized benchmark evaluating AI safety and hallucination rates on clinical tasks. Standardized evaluation is the prerequisite for regulatory acceptance, meaning these tools are actively being hardened for the absolute most demanding enterprise environments out there. Finally, let's wrap up with Section 5, what you should track. With all of these massive shifts happening simultaneously, historic funding, plummeting prices, and major enterprise restructuring, how do you actually cut through all the noise? How should developers and business leaders adapt to this 2026 reality right now? We need to translate these macroeconomic trends into an actionable checklist for your own projects. Here's what you must do based on the data. First, standardize on MCP for tool connectivity. It's a table stakes feature now, not an option. Second, reevaluate your API routing logic. If you're still sending all your requests to premium tiers, you need to adjust based on that new 25-cent Gemini efficiency math. Third, keep a close eye on KV cache solutions like TurboQuant hitting Cloud Inference API soon. And finally, if you are building vertical applications, buckle up and prepare for a fiercely consolidated competitive environment where investors expect you to hold a very deep moat. As you process these staggering funding numbers and foundational infrastructure shifts, I want to leave you with one final thought to ask yourself. The competitive moat in AI is rapidly narrowing. Are you building on the new standard, or are you fighting the current? Keep learning and keep adapting, because as the first half of 2026 has clearly shown us, aligning with these new realities is the only viable way forward. Thanks for joining me for this explainer, and I'll catch you in the next one.